when it comes to the panel, I'm really excited to be joined by this set of panelists. We have representations both from the sell and buy side, so we can get different sort of opinions on how you can take advantage of big data in investing. So that's very exciting. But before we kick it off with questions, I'd like to hand it over to each of the panelists to introduce themselves, and then we can get started.
Sure. Thank you, Peter. My name is Bogdan Yanev. I work at Credit Suisse, so I'm representing the sell side here. I've been there for, this is my 13th year, and my focus is on development of systematic strategies on equity volatility space.
I'm Jib Wilkinson. I'm a principal with Deloitte Consulting and lead our analytics practice for investment managers in real estate.
I'm John Arabadges. I work at BNY Mellon. I've only been there a few months. Prior to that, I was doing a similar type of work, running product R&D teams at State Street for many years.
Well, thank you all. Let's jump into some of the questions. I'll start out with John. You have been with both State Street, as you just mentioned, and with BNY Mellon, working with big data. What are the top 3 things that you think people should think about or know about if they want to become successful with using big data for investing?
3 things.
Just 3, just for now.
Okay, so I mean, I think probably one of the most important things to get a handle on is the data landscape. One of the things I did in the past was work with ESG data vendors. There are hundreds of ESG data vendors, depending on how you define ESG. So getting a sense for the landscape, I think, is very important. I think related to that is whether you're going to build or buy, whether that's the analytics or the software you're building, or whether it's data sets. Are you going to go out and scrape the internet and run NLP yourself, or are you going to turn to your friends at Ravenpack to do some of this for you? Understanding what the trade-offs are there. I think probably the third one I would say is you should, and people have made this comment earlier today throughout the day, you should be capturing your own internal data. There's no reason to ever purge any internal data unless it's a regulatory requirement, because that data will be useful or could be useful at some point in time, and storage is cheap.
So jumping off from your buy or build sort of comment, I mean, and moving on to Jib, you of course speak to a lot of banks or clients that are going through this sort of process of thinking about what their strategy should be around big data. What are the issues that people think about here in terms of whether they should go one or the other route?
I think the key for firms in being successful is to really think about what the future state vision is and talk about how you build a scalable capability. The need to process and handle big data is not new. It's not going to stop tomorrow. But a lot of firms approach it as a set of POCs, and it's a matter of really being able to build a scalable infrastructure for it. And that really comes down to a couple different components. It comes down to, first, the data selection, as John talked about, but I'd take it a little bit bigger about, do you have an ownership model? Who is the champion for different data sets within your organization? And then the next piece is putting the architecture. We've seen up here probably 4 different frameworks for all the steps that happen to get to the data science and the cool outputs we've talked about. And they all start with process, tag, the data, do those. The kind of dirty reality of this is that's about 80% of the work. And getting that to be really scalable for organizations is critically important to having a cost model that works as you go through it. And I think the third part is think about it as an ecosystem play, right? It's you plus your partners doing it. As you heard today, a lot of great offerings, a lot of great models out there. This is becoming more and more available as SaaS offerings, as models for purchase. So think about how you start to integrate those into your organization to do it, and think about doing it with people, not by yourself as you go through it. Right?
Yeah,
I think those are some of the big pieces.
So it's more like a best of breed sort of approach, and realizing perhaps that you can't be an expert on every single data set and so on out there. So you have to work with vendors, but you are focusing on some core capabilities and some infrastructure, focusing more on building the infrastructure to integrate it within the organization.
Right, but make it easy to do that in a scalable fashion.
Okay, and Bobby, from your experience, what are the biggest challenges working working with big data? Is it technology? Is it infrastructure? Pre-processing, introducing new modeling techniques, or is it something completely different?
Yeah, sure. Maybe helps to give a little bit of background about how, me at least on our team, how we use the data. Our focus is to design strategies for others, and so whenever we use data, it needs to be reasonably clean, reasonably replicable, and of sort of a level that can be audited and easily verified by others. When we design something, we want them to be able to replicate it themselves. So our focus is a little bit different from that perspective, but what's very important is to have very clean set of data, something that you can use yourself and others can use, that's replicable by others. So if I open the data set today and open it tomorrow, I don't want it to change, because whatever or however a strategy behaves, it needs to, it's already acted on this, so it needs to remain with the same action. So technology is very important. First of all, cleanliness of the data. Technology is very important. In the options side, we work with certainly a lot of data. There's much bigger sets out there, but even the size of our data is already challenging enough. So having the ability to run multiple tests and calibrations at various times is very helpful. And last but not least, whenever you design a model that uses the data, it's very important to design it in a way that can be understandable and transparent. So however you synthesize the data, being able day to day to understand why your model changed in a certain way is really important for us and for clients.
Cool. I can see we have the first question already coming in from the audience. Can you comment on the role of alternative data in generating alpha? And I'll open up that question for the entire panel.
I'm happy to take a first stab at this, right? I think alternative data is key in generating alpha. It gives you a set of data sets, but don't think about it as just one data set. Think about it as multiple pieces to come together, right? And it comes down to being able to piece together geolocation data along with financial data, along with your internal view of your hypothesis. And again, it comes back to some of the points made earlier about it's proving or disproving your hypothesis, and I would encourage you to think about your models as a portfolio. Some are going to prove out nicely and generate alpha, some are going to fail, and you'll throw them out as you go through this. But that portfolio approach, but I think alternative data is really the key to having new insights and faster insights to what's going on.
I would just add to that a little bit, which is that if you go back 20, 30 years, you look at the data landscape, financial data or data that was used in financial services has typically come from two sources. It's either self-disclosed data through regulatory filings or shareholder reports, and data that's harvested from exchanges. Everything else is pretty much alternative data, right? So if everybody has access to those first two pieces. If you don't have alternative data, you are not really taking advantage of all the information that's available to you.
Yeah. So if we look at firms that have kind of come in late, if we could put it like that, into looking at big data and alternative data and so on, and they may be working in more traditional firms. I mean, how do you manage expectations from management and from the organization as a data scientist that comes in and saying, we bring you in and we want you to revolutionize the organization. Here's a team of 5 people. How do you manage expectations there?
So it's kind of what I refer to as the shiny object piece, right? AI is going to take over the world. We've all heard the buzz around this piece, but getting real on the expectations. The advice that I'll give to clients is to think about it as a series of sprints. And we talked about it earlier with UBS about what's the question you want to answer. Focus on discrete questions you're going to answer, and then use each question to help you build out the infrastructure components and the scale of organization below those pieces. Don't try to build all the infrastructure and then step into it. And that allows you to set expectations. We'll answer this question, or we'll have a first pass at a POC in this time period, and you're able to show results. But you need to keep reminding leadership that each result is building a portion of the infrastructure. Just because the first POC has results doesn't mean you're done.
Any other comments?
I would agree with that. I think you need to target your early efforts onto quick wins. As Jib said, you build out your infrastructure kind of as you go through these sprints, but you definitely want to be able to show concrete milestones as you go down the program.
Yeah. We can turn to some more questions from the audience here. There are more coming through. I think the most popular one right now, what are the best sources of alternative data? So a very nice and big and broad question there.
Yeah, I'm happy to start. I think there are many sources out there, and it's very hard to pinpoint one of them. Obviously we have this conference sponsored by some that are excellent, and there are many others. So, objectively, what makes a good source of data? You have so many options. Something that doesn't have particular biases. You don't want something that have, in our, in my industry especially, very much survivorship biases is something that we try to stay away from. You want data that's clean. You want data that's consistently replicable. And at the end of the day, we're all here because we're hoping to extract some alpha. So ideally, you want a data source or data set that, when properly analyzed, will be able to give you some sort of insights that you otherwise cannot get.
And in terms of value, when it comes to alternative data, how can you? Is it even possible to put a price on it? I mean, how do you figure out what the value is?
I think we saw some models earlier for it, right? The model that I've used is the cost model, right? So if you think about it, the Quant Z guys were up here talking earlier today, and depending on which model you liked on their output, right, the value of putting Ravenpeck's data for sediment over the top of it was 300 to 500 bips, right, in large quantities. If I take that times the size of my fund, I get what my value is, take that against what I get paid for managing that money. Now I've got a top-end number that I need to run the whole process around. So if I've got to take that, and then I'm going to do 10 POCs, and one's going to generate those types of results, and 9 are going to fail, I start to scale it. And you start to get back into what the economic incentives look like, kind of top of the house working down in real simple numbers that people understand, but understand it's going to be directional at best.
We also have a very popular question popping in here around fundamental shops and the use of big data. There's no doubt, I mean, early adopters of alternative data content and so on were more from the quant side, but we are definitely seeing more fundamental shops being interested. What are your views on how they can best take advantage of alternative data?
I'm happy to start. So, one big advantage with these alternative data sources is that they can do analytics of common data faster than a human can. So, for example, looking at some of the Ravenpeck data, it allows you to get a score for a news article, which you can get yourself, but first you have to read the article. So definitely you can get some or alternative interpretation of different types of news perhaps faster. You can get cuts of data from other data sources that might be data that you just can't get otherwise. So maybe there's indicators that leading into earnings can help you analyze. I know people look at data from parking lots or other things out there that could be of interest. So there's a lot of data sources that can provide data that's otherwise difficult to get.
I'd say probably one of the biggest questions I'll get from fundamental shops around alternative data is they see how it works for short term, but not as much for long term, right? And their view is we aren't in it for the short term, we're looking at a longer term horizon, right? And when you start down that conversational path with them, you ask, well, you buy a security, and if you're going to hold it for 2 years, you don't just not look at it over those 2 years, right? And it comes down to fundamentally looking at the investment process, and the investment process doesn't need to change. It's a matter of people with machines and how you go about tailoring, whether it's the research component that's got to happen or the security selection or looking for alternatives, that you can automate some of those steps, right? We saw great examples as far as how you go through news feeds to get the sentiment analysis. We've seen examples with the factor models on how you might pick a universe of securities as you go through it. It's infusing that into your investment process without fundamentally changing it to allow you to do more and have a broader reach and confirming measures, right, as you go through it.
We talked about that early on. It was, can you say, the quant hedge funds that kind of jumped into this space first. We have also seen that it's started out or made its way into stock equity or cash equities side as well first. But if we turn to the macro side, I mean, what are the things to think about there if you want to look at alternative data, big data? Is it different from what you would see in equities? I know, John, you have had some experience working with macro, right?
Yeah, I think there's more of an opportunity, for example, for data vendors on the macro side, only because, if you, for example, if you look at again, the traditional sources of data have been daily prices, quarterly regulatory filings and things, but there's a lot of high-frequency data around the performance of private firms. If you think about macroeconomic data, inflation in the United States is released by the BLS every month. You go to Australia, I think it's every 3 months. So there's a gap there in terms of the frequency and the relevance of the data and the timeliness of the data. So I think where you may have a certain amount of or a certain benchmark that you expect with equity data, if you're looking at data that's affecting rates and currencies and some other labor-related issues, these things you just have to have a little bit more of an open mind in terms of the data vendors, because they are going to fill this gap, but it's still fairly early days.
Any other comments or views on the macro side? Otherwise, we can move on to the next question from the audience. Alternative data. Now it's a regulatory question. So there's a question in terms of what we expect when it comes to the regulatory landscape and how it will evolve towards becoming in the coming quarters. Or perhaps we can extend that into the coming years as well. What do you think there is? Will it restrict can you say the use of the data and the data that we have access to?
I think there always needs to be good data hygiene as people approach these things, right? And certainly on the personally identifiable information and what we talked about with Google and Facebook, I would echo the sentiments from earlier today that I think that there will be regulatory action or pushes on that. It's a matter of when. We'll see more around GDPR out of Europe and some of the privacy pieces. As you get into trade data and some of those pieces, potentially aggregated credit card data, I think it'll be less so as you get through it, right? And certainly, things like ships logs and manifests and traffic and satellite data, I think, you'll see those happening. But the alternative data provider that's flying a drone outside shareholders' meetings and trying to use facial recognition to identify who goes in to figure out whether there's an activist investor that's now involved, I would avoid some of those data sources or just be really careful with them as you think about the sources, right? So understand where the data is coming from before you jump in with a provider.
What about if we look at it from, can you say, more of a traditional insider trading, the illegal kind, the insider trading sort of space? I mean, more and more funds are using alternative data and finding new ways of kind of generating signals. Do regulators, are they able to keep up? I mean, will the funds not always be able to point to some sort of data set that said that was the one that triggered my trade? What are your thoughts around those sort of things?
I would think they'd need to justify why the trade's going to happen, right? And it's not just the funds that are using it. You've got the SEC who's set up, and certainly from the buy side, they're taking regular positions, regular trades, and they're running machine learning and AI against that data set as well to pick out patterns. So, I think insider trading will be harder and harder to get away with as things start to tighten up here.
Good. So, shifting gears a little bit again, Bobby, you work with systematic strategies at Credit Suisse, and you have, of course, been involved with big data in your team. And you also work with a lot of institutional investors that invest in the products that you have created. What are they looking for? I mean, do you see a pressure from institutional investor for you to go out and build data products that are utilizing big data? What's the appetite?
Yeah, great question. I would say it's something that they're extremely curious about. They see this new source of information, and they want to make sure that they use it to the best of their abilities. Now, the thing is, before you actually put large institutional money in any particular direction, I think they really want to understand what's the impact, how, and the biggest question that you will get, the one question that you don't want to get from your manager if they end up losing money is, why, and you not be able to explain it. So, and I mentioned this earlier, but transparency and being able to explain why a particular data, why a particular model acts the way it is very important for them. And so I think most people that we speak to are very interested by the concept. They're really tracking live performance of any strategies that exist in the space. They want to see how they really behave. And I would say, it may move slowly, but it's definitely something very closely watched. And as people get more and more comfortable with it. I think we'll see more and more people start using, they might already be using, but more openly using these types of data.
There's another question here that links to internal content. So the question is, to what extent do you use or license your company's data or your client's data? Any comments?
I can comment a little bit on that. You know, for example, at BNY Mellon and at State Street, you know, the two largest custody banks around, they both use client data for publishing very high level, very anonymized, aggregated measures of world markets, right? So these are not measures that are meant to betray anyone's identity. In fact, if individual behaviors bleed through, that would just be a source of noise. What you need to know is where the crowding risks are. So you want to see where the large-scale movements are going. So both of those firms use client data for that purpose, but they don't take that data and sell it. They don't partner with Cambridge Analytica or Two Sigma or anyone to mine that data for fun and profit. This is all for very, very aggregated, very anonymized measures.
Yep. And at Credit Suisse, I mean, you're from a Swiss bank. I mean, they're generally quite restrictive. Are there any initiatives going on?
Yes, as far as I know, I mean, it's the data of our clients is something that's taken very seriously. So I wouldn't, to my knowledge, expect so.
So there's also another question here in terms of the whole alternative data marketplace sort of maturing. And we could look at some of the data sets that have been talked about a lot. I mean, satellite imagery, news is in there as well, credit cards. I mean, when these sort of data sets become mainstream, what are the types of new data might be popping up and become more widely used?
I think it's going to be IoT sensors coming online and more data from there. I mean, cell phones, one of the ones that I would put in mainstream, right? The geolocation, the ability to track cell phones, the ability to track ships, cars at this point. And I think the IoT sensors will start to come up more and more as a piece that's going to do it. I think we'll also see more around image processing, the ability to tag and understand that. There's some examples out there already about looking at shopping malls and streets and traffic and using facial identification, not to pick out who the people are, but to say, is it the same person walking up and down the street, so you can start to pick out routine traffic patterns as you go through it. So I think there's some examples of this growing.
Any other comments from what do you think would be the next big new data set that would make it into the mainstream?
Well, I think the IoT is absolutely where the data is going to come from. It's going to dwarf everything that's come before it. It's we're talking zettabytes. If you go back 20 years when I was in physics, the big data sets there were, and we didn't call it big data, we just called it data, but they were fairly large. From the Sloan Digital Sky Survey, I think it was around, 100 terabytes or something, and you can look at, accelerator experiments and detectors, you're talking about terabytes of data. Today, the data from an individual bank on all of the information that's going on in that bank is easily 100 terabytes. The Internet of Things, you're talking about millions of times that. In the next 5 years, I think it's going to be quite large. The challenges will be the technology to handle it and process it and to chew it up. It's a battle between the volume of the data and the technology to process it.
I can see there's a lot of interest on talking about this concept of internal data. Many organizations are sitting on tons of data with undiscovered alpha. What would your advice be to them with respect to a data commercialization strategy?
First, don't delete it.
That's a good starting point.
It's a Hippocratic oath, right? First, do no harm.
Yeah.
And then figure out a technology to manage it. But
Yeah. When I've seen firms use internal data, it's largely for operational alpha, is where I've seen them starting to mine it and do well. So not so much as the investment space, but if I use reconciliation as an example, and we've done some pilots here, about 80% or 86% of what shows up as a break on a day-over-day basis is really pattern and systematic differences between systems that machine learning can pull out really quickly. So operational alpha is one of those. The other one that you see is machine learning is very good at understanding or highlighting correlations or tipping points before people are. So to be anyone that runs a call center or where they're getting customer feedback or emails that provide you with customer feedback, it provides a great method for early warning of something that needs to be adjusted or something that's a risk in the process, or even process inefficiencies. You know, the reaction is when we work with clients, a lot of it's done through email, and that back and forth can be informative in mind. Right? As far as commercialization, right, I think that everyone would love to hurry up and commercialize their data and get paid for it to offset the cost of the infrastructure. I think firms haven't really fully gotten there for how to do that, right? And the first question needs to be, is it really your data or is it someone else's data that you're doing processing for, right? So think through some of those pieces as you go through it.
Another operational aspect of that would be, anti-money laundering within banks.
Yeah.
It's very useful to pick out these patterns that seem very odd or maybe hidden, but the algorithms are very good at teasing out some of these strange behavioral examples that you can deploy and trot out to a regulator. Say, listen, we have this program in place, and we've detected these sorts of events.
A lot of the conferences that you kind of can attend in our space, I mean, focus a lot on investment alpha. You brought up operational alpha, and it's one of those areas that people think will be, if not it already is, a big thing, because you don't have this sort of competition for the same alpha. I can reduce my cost to become more efficient in my organization. You can become more efficient in your organization, and we're not in direct competition. I mean, is that, when you speak to clients, I mean, is that the primary focus, or are they still very much concerned with the investment alpha?
I think they're concerned about the investment alpha, but it's a space where folks don't like to share because they consider it secret sauce and kind of competitive advantage. On the operational alpha, folks are more than happy to talk about it, but it turns out the business case is a little bit harder to quantify, right? You know, it goes back to the cost piece. If you increase X bips, I know what that translates to. If I can get reconciliation 25% more efficient, it doesn't necessarily mean that I reduce headcount by 25% as I go through it. So it's a harder business case to make around the operational alpha. So what I've seen is the investments alpha and sales alpha tend to be the two places where firms make a quick business case and move forward quickly on it.
I can see someone here amongst the audience wants us to be a little more concrete. So there's an example. There's a question here asking, if we can provide an example of how we use alternative data in our jobs. So I don't know if anybody wants to take that one, or you file it under proprietary.
Sure, I'm happy to start. I mean, it's I guess it depends to what extent. How do you define alternative data? And in finance, there's so many sources of data, starting from there's multiple stocks that have multiple options, multiple expiries, multiple trades during a day, and there's so many places to look if you want to find big data. So that's certainly one very well known type of data that we use very, very heavily. And even though it's been around for a long time, there's a lot of alpha that people continue to find, and it really gives hedge funds a lot of daily existence and types of strategy. On something a little bit more innovative, we do have a strategy that even looks at new sentiment, that we've worked on with Raven Pack. So that's something that we have used. We find that to be an intriguing type of feature set. But certainly you can really go into any of these data sets and what people have discussed earlier. And if you have a hypothesis, like somebody said, just go in and test it, and you can try to identify some alpha there.
Yeah, I guess I'll put two options out there. I'll do one from the fixed income space for you, which is if you think about muni bonds, right? It's really well researched that the bad news breaks for municipalities and local papers long before it makes national news, and in lots of cases it never makes national news. So when you think about a risk management aspect, the ability to read the local papers and prioritize those in the sediment analysis higher than the national news and understand the original source of it allows you to do risk management on your muni bond portfolio, and that's one that's It's the news feeds with the sediment over top of it, focus on the local piece. So that's one that I've seen. The other one is the commodity space, right? So let me pick on oil and gas because that's a little bit easier. We all know that at regular intervals, there's a government oil inventory report that comes out. But if I follow AIS ship traffic, I can tell you where every oil tanker is in the world. I can tell you when it last was in port and when it picked up. I can overlay that with satellite photos of every oil tank farm in the world. So it gives me the view of oil in motion and oil at rest that turns out to be highly correlated with what those reports come out to be. But now I've got it on a real-time basis. Some folks have layered in over the top of it what the amount of smoke coming out of smokestacks is for refineries to understand how hard the refinery's working. Or when you get into the IoT space, could you start to buy at some point in the future from electric companies the amount of power consumed by the refineries, because that would give you a far more precise view of it. So I think there's a lot of options out there for what people could use.
John, do you have any?
Yeah. So in one of the teams I've run over the years, we built an ESG portfolio analytics platform, ESG being a slice of alternative data, I would argue.
Yeah.
So that was for giving clients a sense for what are their exposures. They have a portfolio of 400 stocks. Where are the sensitivities in that portfolio? Are they exposed to greenhouse gas emissions, Me Too type scandals, whatever the non-financial, typical financial issue or sensitivity could be. It gives them a sense for how their portfolio stacks up against a benchmark, or if they were to take action on their portfolio, if they shot the bottom 5 positions in some ranking, how would that performance have been changed over the last 5 years? So there are lots of our asset manager clients were very interested in looking at their portfolio through a completely different lens, although tied to portfolio performance, of course, but they wanted to see it through these non-traditional factors.
You mentioned just ESG. I mean, it's a space where we can see that there's a lot of demand for data, especially on the using NLP technology and so on. What do you see is the missing data sets that would kind of be the number one sort of thing that ESG investors are looking for that would make their life a lot easier?
I do think not to harp on the IoT here, but I think IoT is going to change ESG significantly. I think there will be sensors around every factory, every utility. I think that's coming, and that will change I think that'll shift the equation from the scraped data and the NLP produced data into the sensor regime, because it'll just be a little bit, maybe it won't replace it, but it certainly will dwarf it in terms of size. So I think that's kind of coming right now. With what clients are looking for today, they want, most of our clients for that platform that I mentioned, they were asset owners who were looking to stack up their asset managers against each other because their constituents said, well, you know what, I know that you're holding Walmart, and this latest shooting, they bought their ammunition at Walmart. What other things you're exposed to that I don't know about? And so they want to be able to see what their plan sponsors are doing. The plan sponsors want to know what the managers are doing. So again, this is stuff I think that will be more transparent when there are data sets that are either required by the regulators. Certainly IoT will change a lot of that as well.
There's another question here on the I guess competitive landscape amongst mutual funds, the big mutual funds and more lean hedge funds. I mean, can the big mutual funds compete with the hedge funds when it comes to accessing new sources of alpha?
Yeah, absolutely. I mean, I think in the grand scheme of things, there's so much data that's relatively inexpensive out there. So, certainly a mutual fund or whatever house can there's so much talent down there. They can certainly go out, get a small team or a couple of people to help you analyze that data. There's so many eager graduates that come with excellent training. There's so much talent from the tech industry and even abroad. You can find a lot of highly qualified people that may not be that expensive, and so I certainly think that they can be very competitive.
I can see there's another question here from the audience around ESG and alternative data, and the question goes, how do we make ESG alternative data more uniform? I guess it's related to some how to normalize the data, perhaps across companies, across regions, so on.
That's a tough one. I mean, there are a few frameworks out there that are getting a lot of publicity. There's a Sustainability Accounting Standards Board framework, SASB. MSCI has their own proprietary framework, Sustainalytics. The United Nations Global Compact is another framework. The issue here is not that there are so many frameworks. I mean, they all want to basically become the standard. They want people to speak the same language, but there are issues that are very difficult to map into another. For example, if I'm running a fund and I don't want anyone to, if I have a personal, let's say, aversion to investing in companies that generate or produce alcohol, right? Now that might be a personal pet peeve of mine that I don't want people to invest in. Personally, actually, I only invest in companies that produce alcohol, but my investors may want me to stay away from that. So again, you're going to have value differences that I think will not be amenable to standardization. On the other hand, there are quantitative measures of carbon footprinting. There's a lot of these things that have been fleshed out, and they are mappable between these different frameworks. So I think that's a work in progress. That's going to take years more. But I think it's moving in the right direction. But at some level, you will always have to have differences in frameworks and differences and you need to allow your clients to customize whatever data you're producing. Like, I'm not going to invest in companies that produce ammunition or cluster munitions, or they have a bad record with funding suppliers who are also involved in human trafficking. That sort of thing you just need to allow for customization.
There's a question here also on the on alternative data and the breadth of data that it provides. However, you often have to deal with the fact that from a time series perspective that you don't have a lot of history for particular data sets. I mean, how do you deal with these sort of things? Is it an issue or not?
Yeah, I mean, I think it is somewhat of an issue. But at the same time, there are a lot of data sets that do give you a lot of data. The stock market has intraday data going back for a very long time, and that's a lot of data if you get down into the ticks. Time series analysis combined with machine learning can be an interesting exercise, as we all know, and definitely a lot of caution should be exercised because there are many properties of any time series that change over time by definition, and it does make the analysis challenging. Definitely what you need to do is break out your data in different periods, see how things are changing, and really decide if whatever phenomena you're looking at are still relevant today, because what was relevant 20 years ago may not be relevant anymore. So that's also another important point, is that you perhaps don't want to have too long of a data set. Maybe whatever you want to study from 100 years ago wasn't as interesting or applicable today.
So I guess at the end of the day, it comes down to the application and the prediction horizons that you're focusing on. So yeah. Of course, if you have long prediction horizons, you also need more data to kind of help you there. But I'm also seeing, from talking to funds, I guess it also depends on whether it's a new data set that you're bringing on board, or whether it's something where you already have a data set, perhaps with longer history, that belongs to the same sort of type of data, such that you kind of already know the behavior, and then to see if you can mimic the same behavior with the new data that has shorter history.
Yeah, I mean, sure. There's always the story of a small company that discovers a particular data set they have had that might have some value to others, and they decide to explore it. Obviously, that's an example of some time that you discover a new data set, but with some history. Now, if you get a brand new data set, like some of the IoT that's been mentioned, it's kind of a different story.
Yeah.
And how do we handle, like, let's say, improvements in technology? I mean, that could be the underlying data not changing, but then there could be the technology on top that kind of structures or makes sense of that data. I mean, right. Technology will improve. How do we deal with those sort of things as part of an investment process where, at least as a quant, I mean, we would like to have data which is point in time sensitive, but that could be, there are many different definitions of what that means.
Right. I think that's a matter of really building your data foundry process to understand that it's going to vary and that you're constantly going to be creating the next generation of model, and you need to be able to compare it and explain it against the last generation of model. I think it comes really down to the explainability as you go through it.
It's like version controlling in
Right,
some way.
it's version control. It's whether, it was talked about it as the hygiene process earlier today. Make sure it's a really solid process. Make sure it's really scalable. Goes back to the point I made about, it's great to run a set of POCs, but if the POCs don't have an underlying standard process or standard architecture or standard talent model below it, you won't get the scalability out of it. You'll end up with lots of different options where it doesn't fit together and it doesn't, you don't keep compounding and growing as you go forward too. And I think the data collection and validation process at the beginning is critically important.
Yeah. There's also a question here around overfitting. I mean, how do you avoid overfitting when continuously integrating alternative data sets?
Yeah, I'm happy to take a first crack. I mean, it's a challenge, and it requires a certain amount of skepticism and requires a lot of stress testing and just sensitivity testing. We all know the various methods of cutting the various types of data into subsets and testing in sample versus out sample, and then going live and testing live. At the end of the day, live is the ultimate test for data, and we have certain investors or many who wouldn't or who would certainly wait a certain period of time until we have live data, because no matter how much stress testing and sensitivity testing you do, there's always some amount of skepticism. So definitely a certain amount of skepticism should be there.
There's a question here that relates to a previous one that we had in terms of, how do you set the price of an alternative data set? We talked a little bit about the value.
Yeah.
I would say from a vendor side, it's going to be as high as someone is willing to pay, but I don't know if you have a different view on it.
I think that's true, but you also need to, so for example, if I wanted to scrape sources, distill some proprietary signal out of that, what would I have to do that myself versus going to a vendor for that? Well, I'd have to hire, let's say, 3 people to do this, right? And that's probably a pretty lean team. 3 mid-level analysts, let's say, with their benefits, they're $200K a piece. I'm going to spend $600K, or I could go to the vendor and spend $100K, right? So there's cost implications there and scalability implications that are tremendous. And that, just having the 3 analysts working on this doesn't guarantee that they're going to build a scalable system that's going to be able to work in production, et cetera. So there's lots of costs around a build as opposed to a buy. So I think that's probably one of the main considerations that need to be really closely looked at.
I think it's actually a very interesting question also from the sense that when people take a trial and run a POC on alternative data, I mean, they will test it, they will see if they can make some money off of it, and they might have some sort of model saying I need to be able to make 5 or 10 times the cost of the data set. I mean, but often the POC is a limited time period. I mean, they might get 3 months or to test it and find value. But the thing is, I mean, I tend to say, for instance, that certain data sets are almost like lifetime data sets. You can spend your entire, or career data set, you can spend your entire career finding value. I mean, is it reasonable from the client side to say, okay, if I couldn't find all of the value in 3 months, I'm only going to pay this? There might actually be a lot more value in the data set.
I think you could structure it in that case so as they find more value in it, it increases the price. But I've been a big proponent with clients about how do you fast pass or fast fail a data set, right? Because there's so much data available, and that's one of the big pieces. You can spend too long in the analysis piece. So a favor of kind of that short pilot to prove or disprove, knowing that that is a point, not the end of the road.
Yeah.
If it looks promising, it's the next piece that kind of carries it forward, right?
So it's also potentially like a change in mindset and say, is this data set interesting enough for us to invest in it?
Right.
And say in the longer term, we will be able to pay it back because it has the right quality, it has the right sort of breadth and a potentially interesting hypothesis to address with it and so on. And then you don't have to, can you say, have paid for it already through your POC?
Right. I think it's a portion of that, and it's having a portfolio mindset,
Yeah.
right? You know, it might be 50 different data sets you're looking at, and some are going to pay off nicely and do better than your expectations, and some are going to be losers as you go through it. And it's going into it with that mindset.
So it's almost like you have to buy data sets the same way as you buy stocks.
A little bit.
Yeah.
Yeah.
So there's another question here on how traditional institutional investors can prepare themselves to deal with external managers that are using big alternative data. Should it change their process?
I think this is pretty interesting because I've had a number of conversations with big traditional institutional investors who are thinking about how do they take a look at big data and use it as part of their process for how they oversee and how they look at the risks in their portfolios. So it's not just how do they view their manager's use of the data set, but it's how are they thinking about using it internally for some of their oversight processes or to better pick managers as you go through it. Kind of what I've seen is with the buzz in the market around the strength of analytics and data, that I believe managers that have got a strong story to tell about use of data are able to get a bit of a pricing premium at the moment for those pieces. And certainly with the institutional space, being able to prove that you can actually use it is a value.
I think that's a very interesting question here as well, and I think it will be the last one that we will take before we can go to the bar, all of us. There's a question here in terms of when testing alternative data and building up strategies based on alt data, how do you deal with regime shifts? I think it's interesting also because of one of the comments that Gordon Ritter made that in terms of actually trying to use alternative data or to figure out what regimes you were actually in. So I mean, this sort of non-stationary sort of problem, how do you deal with that?
I mean, that's a great question that will be equally interesting to answer with regular data sets. I mean, it's always a good question. And I would suspect the answer will be pretty similar. At the end of the day, first, how do you identify the regime shift? That's the big question. You know, is it something that you want to? Obviously, what you want to do once you identify it is recalibrate your model, but it's not that easy to identify it. And there's so many situations where maybe you want to just run a couple parallel models, see what the difference in conclusions will be, or maybe you want to have some sort of a tolerance that's time dependent to say, okay, this particular regime persists for some time. You know, other than the obvious techniques of having some sort of a regime switching model or something like that. But it's not an easy answer.
I think we'll wrap it up here. I had a lot of fun on the panel. I hope you did too, and more importantly, I hope the audience also had fun listening in.
This is Raven Pack.